On today's Hot Sheet, I'm discussing the S&P Cotality Case-Shiller Indices for August. What a name, guys. The FOMC Preview, the Fed meets starting today, and Fannie Mae's revised forecast. Today is Tuesday, October 28, 2025. I'm Byron Lazine, and the Hot Sheet starts now. Live from Naples, Florida. Good to be saying that 2 days in a row. Really good to be saying that. Love to know where you're coming in from, wherever you may be. It's a pleasure to be with you here today. All right, we've got the gold standard of lagging data, the S&P Cotality Case-Shiller. It's the U.S. National Home Price Indice that is most viewed as that, the gold standard. Okay, so this index, as of August, when I say lagging data, we're about to enter November and we're looking backwards into August. But this is how you know it's accurate because we've got a 2-month plus gap in between. Okay, 1.5% increase on this S&P Case-Shiller Index, which is now combined with Cotality. Very long name, confusing, but a 1.5% home price increase in August, slowing from the 1.6 the month before, and it's the weakest gain, okay, the weakest in over 2 years. What have we seen throughout the year? A consistent decline in the amount of gains that we are seeing on national home prices. This gain has gotten smaller and smaller and smaller, okay? That was as expected. This isn't new information or anything that we should be shocked by. 19 of the 20 metros also, though, saw monthly declines. So they have these 20 major metros, S&P Case-Shiller, that they track, and 19 of the 20 had a monthly decline. Chicago, shout out Chicago, was the lone gainer out of the 20. Okay, so inflation outpaced home price growth for the 4th straight month as well. Okay, so 1.5% in August. It's almost moving flat, right? If you consider the inflationary target at 2%, 1.5% would be sub-inflation, which would basically mean no home price growth if you factor in inflation. Weakest annual gain in over 2 years. That is to be expected throughout the rest of the year. Okay, the 10-city composite went up 2.15% rather year over year, down from 2.3% the previous month, and 20-city was up 1.58% year over year. Now, I said 19 of the 20 went down month over month, but year over year on the totality with the 20 cities, those were up 1.58%, down from 1.8% the previous month. Okay. Now, what does that tell me about the seller in this winter time period, getting into the winter, the end of the fall, winter, and hitting that, that spring market? They're starting to see prices soften. Okay. Soften up. Now, you may be in a market where it's pretty clear these numbers are going to continue to grow due to inventory. Or you may be in a market where the inventory increase isn't impacting price, and price is kind of holding firm. Some of those northern states versus some of the Sunbelt states. So it's going to be really important for all of us real estate professionals to position the timing if they have to hit a certain timeline with their needs, right? Like, hey, what's riskier, like getting on the market now and, selling to the buyers that are out there right now, or risking these extra percentages that can roll off between now and early next year. Because as the data continues to come out over the end of the year and we get our typical national seasonal decline on prices, we expect these numbers to keep moving down for that gap, that year over year gap, to continue to get a little bit smaller. Okay. Here's what it looks like on the 20-city composite if we're looking at that. All right. Year over year change, most are up. Okay. Tampa's The biggest decliner year over year at 3.31% to the negative. That's what I'm talking about with some of these Sunbelt states. Like, it might be riskier in Tampa, right, to wait for that number to get up to 5-6%, as opposed to having a great invitational price now when there's less competition. There'll be more competition in Tampa as we get into the new year, as we get into that spring market. So that's a conversation. That's part of what I was just describing, sitting down in front of a would-be seller who's thinking about when is the time for me if I need to sell in the next 6 months, right? If I need to sell in the next 6 years and money's the most important thing for me, well, I'm probably not selling in Tampa. I'm crossing my fingers that no storms come the next couple of years and letting things bounce back up. 1.19% in Dallas for the year to the negative. Denver's down 0.72%. 1.5% in San Francisco. San Diego's down a little bit over 0.5%. Phoenix is down over 1.5%. Miami's down over 1.5%. These are the 1 year changes. The month over month change, all 19 of 20 are down. The only one that increased and didn't increase much, increased 1/4 point, was Chicago. So all are down. Some of the biggest month over month changes were in LA at a full 1% down. Portland, a full 1% down month over month. Those are the biggest movers to the downside. Out of the 20-city composite, you've got San Diego. So the West really moving down. San Diego and San Francisco, almost 3/4 point down. Seattle, almost 3/4 point down. Not dissimilar to what's going on in Tampa, lost another 3/4 point month over month. So there's your 20-city composite. What's happening right now? Well, not right now. 2 months ago for the S&P, which is the gold standard on pricing in the 20-city composite. It tells the story that we expected to see, that these numbers are continuing to soften, especially as we get later into the year. Remember, August is supposed to be a time period where things might be just off of the peak for the year. We've seen a decline into August, and we're going to continue to see that moving forward throughout the rest of the year. All right, it's Fed week. Personally, one of my favorite weeks, as frustrating as it may be. I mean, listen, there's no reason to get political with it. Jerome Powell has screwed these weeks up multiple times by his own doing, not a political statement. It just happens to be the truth. You know, he gets up there on that presser on Wednesday afternoon, and we're going to get to see it tomorrow, and he stumbles and bumbles and fumbles. I'm not saying it's a hard job. You know, you put me in at, quarterback for the Indianapolis Colts. I'm not going to look as good as Daniel Jones. It's surprising Daniel Jones looks this good. He was a New York Giants quarterback, and he never looked this good. But if you put me out there, I don't have the same skill set as an NFL quarterback. I'm going to be stumbling, bumbling, and fumbling. I'm not an expert on NFL quarterbacking. I can tell you that. Playing a couple snaps in high school doesn't get you there, right? And Jerome Powell seems just like he's he's in a different league, not like a good thing. Like, oh, you're next level. No, it seems like he's playing minors, and the market's in the major leagues. The market's going 18 innings like the Dodgers did last night. Like, he's out of his league in a bad way. He's not matching up. He continues to fumble the bag. We've seen momentum now over the last couple of weeks on the rates. We saw it in the couple of weeks leading up to his last presser when they decided to cut 25 basis points. At that time, he came out there and he started off strong in the presser. Like, it seemed like there was a plan. And then as they asked him more questions, that plan disintegrated. It was weak. The press poked holes in it. The investors saw those holes, and they fill them with other ways to think about the market. Okay. And what did you see? The rates went up. Okay. So it's pretty much baked into the cake here. What's going to happen tomorrow when they come out with their decision? The FOMC is going to reduce the Fed funds rate by 25 basis points. That's going to put us at a target range of 3.75% to 4%. Okay. Most participants currently expect the FOMC to also cut rates an additional 25 basis points at the December meeting. This matches up with, not only what the participants believe, the participants of the committee, and we saw that from the dot plot plan the projections last meeting, but it also is in line with what investors, CME Group, and betting markets, Polymarket, believe. And those are the two I look at these more so than what the committee projects out into the future, because they'll kind of ride political influences. Sometimes they'll ride the wind and all of that. But CME Group, people with a lot of money, okay? If you're like, what's the CME Group? Lots of money, big time investors. 96.7% on a cut now. But if we look at December, they're near 90% chance of a cut in December. Okay, so this preview of the FOMC meeting that we're taking a look at, saying, hey, the analysts believe that there will be a December meeting. Well, CME Group matches up with that there'll be a cut in the December meeting. Polymarket, when you get inside of like a week of, whatever's being bet on, and there's a lot of different markets now on Polymarket. There's not just financial, there's politic market, sports, crypto and all these kind of different things. Polymarket, it has been proven now that you get inside of like a week, this thing is deadly accurate. Obviously, we're within hours of the FOMC decision here. It'll happen tomorrow, 98% chance that's going to happen. As we look 6 weeks out, in line with CME Group, a near 90% chance that there's going to be a 25 basis point cut. So we're looking at this meeting here as kind of the first of two more cuts this year. We just had a cut. So ending the year here with 3 cuts. That's the expectation. If we look at how Bank of America is thinking about this meeting, okay, Bank of America says the Fed has indicated that it'll cut these 25 basis points tomorrow. We also expect the FOMC to announce an end to balance sheet runoff, something we talked about last meeting. But the broader shift in focus toward the labor mandate probably won't change, okay? Now, we haven't gotten labor data because of the government shutdown. We did get a pretty sizable kind of thermometer of what's going on in the job market, a temperature check, quick gut check. You know what that is? If you were just in the BAMX role play, we do that every single Tuesday before the hot sheet. Jump in there. But quick gut check on the labor market was just done by Amazon. Okay, so if you saw this last night, Amazon is planning job cuts of near 30,000 jobs. This will be the largest job cut in Amazon's history. Now, the updated one here today says Amazon laying off about 14,000 corporate workers as it invests more in AI. The report I saw late last night, or late for me before I went to bed, had said upwards of $30,000. They said Tuesday they will lay off about 14,000 corporate jobs. The latest cuts, AI becoming, and so here the layoffs are expected to ultimately be the largest corporate job cuts in Amazon's history, touching nearly, I don't know what the heck that is, area of the company, touching nearly every. Come on, CNBC, get your game tight, CNBC. So the cuts could affect as many as 30,000 employees, according to Reuters, which cited sources familiar with the matter. Okay, so there you go. You've got maybe a quick gut check for Jay Powell without that government data because of the shutdown on what's going on with jobs. What do you know? Oh, Amazon's doing it. I've got cover. Maybe I'll jump into the game. Good day to announce our job cuts the day after Amazon announces. And what do I see this morning? It's UPS is deepening their job cutting as part of a turnaround plan. Okay. Now, Wall Street likes this one because their stocks have surged on this news. Company said it's going to cut around 34,000 jobs from the workforce this year. So, just in time for your holiday packages, folks, UPS is going deeper on their job cutting plans, 34,000 jobs. So this might just be a little bit of a gut check for Jerome Powell. I know he doesn't like real-time data. He only likes to wait for outdated government data. But hey, if you take a peek around what's going on, those job and labor concerns that you had when you had the data don't seem to be getting all that better, because what we didn't have then, which we are starting to see some stories of now, is the layoffs. And now there's 7 million job openings, but we haven't necessarily, we don't have a guarantee that those 30,000 workers are going to be a fit for those 7 million jobs. Why have we just been sitting on 7 million jobs? Okay, maybe every employer out there is looking for somebody proficient with AI, and there's not 7 million people proficient with AI. And so, yes, over time, I'm not one of those. I see. I'm not sure if I don't know, Jason, are you referring to AI 600,000 less jobs over the next 8 years? I'm not one of those AI doomers. I do think that there's going to be AI that replaces jobs, and there's going to be a transition period for people to adapt into the new jobs that become available. New jobs always become available with kind of some of these disruptive economic changes that we go through, but it might not be right away, right? And I think that's kind of the scary part for a lot of people. So the broader and it should be scary for real estate folks too, because if people are losing their jobs, then Jason's referring to Amazon, 600,000 less jobs over the next 8 years. That'd be interesting. They're at 1.5 million. They're a top 3 employer in the country. I haven't seen that report, but I will take Jason Fleury's word for it on that. So the broader shift in focus toward the labor mandate won't change. And this is what's going to give Powell the cover against his political friends, I'll call it, where they say, hey, we're scared of big bad tariffs. You need to make something happen here. Really, it's kind of people that want to hurt the economy. The cover he has on that is like, we've got a labor mandate, and we need to really pay attention to that. He's unlikely, according to Bank of America, to offer much guidance beyond this meeting. I mean, you can copy and paste that. He never really has a succinct plan beyond the meeting. Lack of official sector data and the current labor consumption conundrum. Our base case is there will be, again, only one dissent, where you will get Governor Moran, who would like to see a larger cut, a 50 basis point cut. And they see meaningful risks of at least one hawkish dissent as well. So remember, the Fed typically doesn't disagree as they have right now, or in recent meetings. That's not typical, but Bank of America projects that this will continue to kind of be the story of today's Fed. Here, just an update on some of the projections, right? We saw projections from September's meeting. They upped GDP in September's projection from 1.4 to 1.7. So the economy essentially is outperforming in terms of GDP what the Fed had expected. They continued to have to bump this number up based on data that they were collecting throughout the year. So GDP performing better than what the Fed's expectations were. In September, they bumped that projection up again from 1.4 to 1.7 in real GDP for the end of the year. Next year, they've bumped it up from what they had previously at 1.7 to 2.1. Okay, so, and then 2027, you see 2% real GDP. These aren't like numbers to like throw a parade about or anything like that. Unemployment projections, they now have at about 4.5 where we'll end this year, which is interesting. Last we knew we were at 4.3. So Fed expects unemployment to increase throughout the end of the year. And I guess those Amazon announcements and UPS announcements would support that. Sticking with that 4.4 to 4.5 number next year and 4.2 to 4.4 in 2027. Inflation have us ending the year at 3. That's right where that CPI report just came in at. So Fed's not seeing any changes through the rest of the year. 2.4 to 2.7 next year. So the Fed sees inflation continuing to move down. Core inflation projections ending the year at 3.2 potentially, and then next year between 2.5 to 2.7. All right, there is your Fed update. We'll be watching very closely for what Jerome Powell mostly says about the future of rates and housing. We're going to break it all down here Thursday on the Hot Sheet. If you're on the YouTube, make sure you're subscribed. Hit the notification bell so that you don't miss it. We extract all of the data from that Q&A. We extract all the transcripts on every mention of housing, and we break it all down here the day after. We do that every Thursday after the Fed decision. We'll be doing that this Thursday. Looking forward to being with all of you for that. All right, Fannie Mae has an update on their outlook moving forward. Okay, I'm really curious on this one. I'm really curious on existing home sales with Fannie Mae. Before we get to that, let's just take a look at their updated projections on GDP and the economy overall. And then we're getting into housing, where I'm curious if their 10% bump on existing home sales sticks with their updated projection based on the new data that they've collected over the last 30 days. This is the economic forecast for 2025 from Fannie Mae. Okay. Economic forecast just released from Fannie Mae puts GDP at a 1.3 bump here in quarter 4, 3.1 for quarter 3, putting 2025 outlook at a total of 1.9 on GDP. Okay, so the 1.3 in quarter 4 would be a sharp decline from the two middle corners, but that's kind of not unlike what we saw last year. You know, last year we saw a just under 1% GDP increase in quarter 1. We saw 3.6 and 3.3 in quarter 2 and quarter 3, and then 1.9 for quarter 4. This year, quarter 1, we went negative 0.6. We saw a big jump up in quarter 2 to 3.8. 3.1 is the projection, the updated projection here for quarter 3. And then 1.3 for quarter 4 on gross domestic product GDP coming from Fannie Mae. CPI quarter 4, Fannie Mae has us coming in at 2.9. And the year over year number that we just reviewed yesterday was 3%. So Fannie Mae does not see an inflation issue here for quarter 4 based on those numbers. They actually have it moving a tick down based on this data. CPI core, so excluding food and energy, coming in a little hotter, 3.1 for quarter 3, 3.1 for quarter 4 on the projections from Fannie Mae. PCE, which is the measure the Fed likes to use, 2.9 for quarter 4. So overall on inflation, Fannie Mae not seeing a major issue or concern there, which obviously will give Fed cover to continue these rate cuts. Unemployment rate, 4.3 for quarter 3 is the projection, and then 4.4 for quarter 4. The federal funds rate, they have us ending the year at 3.8. So kind of in the target of where this next cut is going to be. Interestingly enough, 10-year, they have the 10-year moving up from where we are today to a total of 4.2. So Fannie Mae expecting an increase in quarter 4. If we move over to their housing forecast, Fannie Mae's housing forecast for October 2025, we take a look at housing starts. They're projecting housing starts to come in at about 1.3 million in quarter 4 on the year-over-year seasonally adjusted number. They expect a negative 1.5% change on housing starts year over year as we close out this year. Next year, they have a near 3% to the negative change on housing starts. So Fannie Mae over the rest of this quarter and next year are projecting that housing starts trickle down, okay? On single family housing starts, they expect that number to be even greater, 7.4% this year, 2.4% next year. That's because multifamily this year, they're projecting a 15% increase on starts. Yet next year, they're expecting that to cool off to 3.8% down. All right, total home sales. The expectation right now from Fannie Mae, when you take existing and new home sales, is that we're actually going to move down 0.2%. So the struggle continues. The basement continues on home sales over the last 3 years. We do not get an improvement this year based on Fannie Mae's projection, but we do get a bump up on total home sales to 8.9% on Fannie Mae's latest projection on total home sales next year, going to 5.159 million total home sales. All right, new single family, so new home sales expected to move down 1.9% this year, but move up 4.7% next year. Welcome sign for builders on the Fannie Mae 26 projection. Existing home sales, the one I really am focused on, Fannie Mae is holding firm on their near 10% increase for 2026 on existing home sales. On an exacto measure, 9.6% up for 2026 existing home sales. If you do the math on your basic on your general market, do the basic math, 9.6% up. Okay. So how many sales have you done? Add 10% increase to that. And remember, 10% of an increase, if that's a couple thousand sales, that's a couple thousand times 2 on sides. Opportunity is according to Fannie Mae in 2026 going to be significantly greater than what we've seen the last 3 years. Now, to me, this is best case scenario. Love to see it hit. Obviously, 10% increase, you'll feel it. Okay. So a 10% increase, if that were to be the case, then my belief would be, as real estate professionals care about the housing industry and care about your business, that you're investing into that increase now. There's risk involved because if it goes flat, you've got to now outperform the market. But I would, if you believe in this for your market, I would make those investments and continue to grow your business, because if you get the tailwind of 9.6%, that investment certainly will pay off more than the 10%. 30-year fixed mortgage, they've got us at 6.3 for quarter 4. That's a tick higher than where we are right now. So Fannie Mae projecting 6.3 quarter 4. And they don't have us at a 5 handle until quarter 4 of 26, 5.9. They have us in the low 6s the first 3 quarters of next year. Don't love that one. And I'm just not sure we get to a 9.6. I've said this in the past. I'm not sure we get to a 9%, 10% increase on existing home sales without a 5 handle, even a high 5 handle next year. So those 2 projections from Fannie Mae, to me, I'm no analyst, but they seem to counteract each other a little bit. Okay. All right. Fed meeting kicking off today. Where's the 10-year sitting at? 10-year has improved a little bit from yesterday. Another signal for all those Instagrammers who wanted to be political about the CPI report of this week. Really just uninformed, uneducated takes out there on the internet. 10 years showing us another sign that 3.995, now under 4. Another sign that, we're not worried about inflation. Fannie Mae's not worried about inflation. The Fed's projections are not worried about inflation. The CPI report was better than expectations. And oh, by the way, the stock market's not worried about it at all because they set another record yesterday. So I get it. Some, partisan cutesies on IG want to blow up and go clickbait on inflation. It's good for clicks. It gets you past another day of what to post, but it's not reality. Here's the 10-year today going into the Fed meeting, 3.995. That could be good news for the 30-year fixed. I saw some of these analysis last week, if you want to call it that. Rates are about to go up. Rates only go up if Powell pukes on himself tomorrow, which is completely possible. 6.19, the same as when we ended the week last week. We're in that low range, almost the year-to-date lows that we saw before the last Fed meeting when Powell did, in fact, puke on himself a little bit. Okay. Fed watch, poly market watch. We got a near 100% certainty that we're going to get this cut. If Powell's paying attention to any real data, Amazon, UPS, if he believes more layoffs are cutting, it might even be wise to do both cuts. The December cut included in tomorrow's cut. Don't expect that. There's a less than 1% chance that is the case. But you never know. All right. Hey, here's the deal, guys. If you're wondering, hey, what should I post so I don't get kind of wrapped up into those cutesy pontificators on IG that's Byron's talking about? If I don't know what to post, when to post it, don't worry. BAMX, we just solved that for you. Every single week, new this week content, hyper local templates that work for you and for your brand each and every single Friday. These templates are designed by the BAM team, the same team that creates all of the BAM content. Not only that, we give you emails and video scripts and newsletter scripts every single week, new content. Go to the New This Week classroom, BAMX members. Grab your content each and every single week. Every single day that I do the hot sheet, I give you all the slides and notes that I use right here in one place so you can find it, the hot sheet show notes. This is how we bake the cake here over at the hot sheet so you can run your own version of the hot sheet. Along with that, all of our courses, Sharon Srivatsa's Knowledge Bank, access to Zudilio. This is a free you just get it as a BAMX member, $2,400 value, cash offer platform. Everything you need to know and how to sign up is in there. All of Chris Benjamin's social secrets, Andrew Undum's systems, and more, all included inside of BAMX. You get access. If you want to convert more, you get access to our live role plays every single Tuesday, live role play masterminds with myself, Tom Toole, Lisa Chinati. Today, okay, we have new member onboarding. So if you take me up on the 7-day free trial right now, go to school.com/BAMX. I'll let you try this for 7 days. You can come into the new member onboarding today at 4:00. And immediately after that, we have a live BAMX member only session with Chris Benjamin and Jordan Cohen. Jordan Cohen is the #1 RE/MAX agent in the world. Over 300 million annual sales. I mean, he's worked with, some of the legendary actors of our time, including Sylvester Stallone, professional athletes like Anthony Davis and others. Jordan Cohen with Chris Benjamin today, 4:30 BAMX session only. And we run these role plays. If you want to just convert, you're not converting, jump into the BAMX role plays every single Tuesday or some of the other BAMX sessions. If you're lacking any guidance from your office, I hear that a lot right now. Hey, my manager's they're always recruiting. They're always doing this. Then that's why we've got the community in those live sessions. So BAMX, if you need some community, if you don't know what to post, when to post, or you're just not converting at the level that you want, join the community that helps agents close more deals than any other community, BAMX. School.com/BAMX. All right, there's your hot sheet for today. Really appreciate you guys. Appreciate that man right there, 1,000 watt, the best branding company in the world for real estate, Mark Davison in the chat. All right, hope everybody has a great day. I will see you back here tomorrow. We'll have a Real Word pod up later on the channel. Until then, of course, toodaloo.